This podcast is brought to you by AJ Bell and Shares Magazine. Shares Magazine is published by AJ Bell Media, part of AJ Bell.
Hello, welcome to another jam-packed episode of the AJ Bell Money and Markets podcast. I'm Dan Coatsworth, and with me this week to try and gnaw our way through all the market news is Danni Hewson. Hi there, Danni.
Hi, Dan. Yes, investors, I think they might be forgiven for feeling that they've suffered from whiplash as US markets entered correction territory as the US president confirmed 25% tariffs on Mexico and Canada. But a few words from Donald Trump's commerce chief suggesting that deals will be done. Then the sentiment shifted from risk off to risk on today.
Yeah, one sector that's benefited from the global volatility is the defence sector. We've seen a significant uptick in share prices of some of these big defence companies across Europe. Of course, that's helped to lift stock markets, including the FTSE 100, which hit a fresh record high earlier in the week. Now, we asked Tom Siebert and Ian Conway from Shares Magazine to come on the show to talk about one of these stocks, which is BAE Systems. So don't miss that deep dive later in the podcast.
Now, just about everyone, I think, I hardly know anyone that doesn't love a Greggs sausage roll, but have price rises and healthy eating habits taken the pot off the boil when it comes to growth? Plus changes to listing rules, which will allow companies with a euro or dollar share price to join the FTSE Russell index from September. Dan's going to dig through what all those changes might mean for London markets.
Plus, we're also going to chat about how to plug gaps in your national insurance contributions back to 2006. That's all about making sure you get more from your state pension. We'll hear from AJ Bell's Head of Public Policy, Rachel Vahey, about what to do and what it all means. We're also going to chat about the return of the sub 4% mortgage.
Yes, but we have to start with Donald Trump and tariffs. You know, Dan, I, like you, tend to do a lot of broadcasting in the morning, quite early in the morning. And Donald Trump, sitting in his Oval Office, tends to drop a bit of a bomb. And you wake up at 4:00 in the morning and you go, okay, what's happened now? And I have to say that at the start of the week, we were watching this deadline draw closer and closer for the implementation of tariffs on Canada and Mexico and an extension of tariffs on China as well. Now, the Canada and Mexico tariffs had been pushed back for a month. And I think there had been a sort of expectation almost from investors that this would get worked out. That certainly seemed to be how things were going. We hear a lot about Donald Trump being this transactional president, that he's using tariffs as a negotiating tactic. But suddenly they were really real. We got from the White House, from Donald Trump himself, the fact that these tariffs were going to come in. And immediately you got the tit for tat from Canada in particular, saying that they were going to implement their own tariffs. Mexico clearly incredibly unhappy. And China, who'd been hit by a doubling of the tariffs, they have already made huge moves. And I don't quite know why investors have been so surprised that these tariffs seem to have been come in, apart from the fact that even now, we're not sure if they are in, they're in now, but how long they might be in for. I mean, it's impossible really for investors to try and pick their way through this because Donald Trump says one thing, does something else, then does the original thing, and then does something else entirely. It does feel like investors have got a bit of whiplash. And we saw that in markets because US markets in particular, we saw that Trump bounce that we had upon the election of Donald Trump obliterated on the news that these tariffs were going to come in. And yet now we're seeing a lot more sort of optimism from markets because there have been suggestions that it might not happen after all.
Yeah, I mean, as we're recording this, we'd heard from US Commerce Secretary Howard Lutnick, who sort of implied that we could see some of these new tariffs slightly dialed down. So even if have tariffs of some form still intact, the prospect that they might be slightly less punishing seemed to be enough to get investors pretty excited. So, I was having a look at the sort of the 1 week share price charts for some of the markets, and they kind of follow very similar trends. They had last week was really good. Then this week at the start of the week we had a wobble because of these. It turned out these tariffs were coming in after all. Now we got the prospect that they might be dialed down a bit, so we got recovery again. So obviously, by the time you hear this podcast, who knows what will happen next? But I just think that investors sort of are just looking for any nuggets of proof that Trump is open to hearing what the other side has to say. I think he's done a lot of talking. Certainly, I was just hearing he did this big speech this week. I don't know if you heard it, Danny. Hour and 45 minutes, longest sort of summary of his first 6 weeks in office.
Oh, yeah. It was quite the watch, wasn't it?
Yeah, he's never heard of Lesotho. He obviously doesn't know where all the diamonds come from, and it's quite some quite remarkable comments we heard, during that sort of thing. But there wasn't really, there wasn't anything particularly new. But it was just emphasising these policies here. But to me, it was just a reminder that he seems to think that obviously tariffs are good for America. Lots of people in America don't share that view, and they're very worried. But the conversation is growing about how the next thing we'll see is that more companies basically shifting their manufacturing there. So maybe this is what he wanted all along. He wants people to, put their operations in this country. That will create jobs. That will make him look good for the nation if he's creating more employment, and of course then that spending potential feed through into the economy. But I think people are very worried about how prices are going to be going up for goods that are coming into America, and that will cause inflation. So people are thinking we're treading a very fine line here we're heading towards a road down to recession. So he's 6 weeks into this term, but it feels like he's been there for a long time. I can't believe the amount of stuff he's rolled out. It is something every day, isn't it, Danny?
It is something every day. And it's really interesting what you said about heading towards recession, because, of course, now the expectation of further rate cuts from the Fed have dialed up. And that is something that Donald Trump wants. Another thing that Donald Trump wants, exactly as you said, is investment, people bringing jobs to the United States. So you've had the commitment by Apple. You've also had the commitment by the Taiwan Semiconductor Manufacturing Company to bring chip making production facilities to the United States. But the problem with all of that is that we've already had a sort of investors taking a look at that move thinking, well, what's that going to do to the cost of those chips? And therefore, what is that going to do to Taiwan Semiconductor's margins and their ability to make money? And on the flip side, with the consumer, we had an update from Target, just like Walmart and Home Depot, all saying, look, we just can't figure out where tariffs are going to go here. We can't give you a full outlook because we just don't know. The one thing that we can say is that supply chains are long and they take time to move. So if you want your avocado and we're getting your avocado from Mexico, we might be able to source it from somewhere else next year. But this year, we're probably still going to have to bring it in from Mexico, and you, the American consumer, is going to have to pay for that. So I do think you're absolutely right. I think some consumers are incredibly nervous, but others are just looking at it and thinking, well, look, you got to break a few eggs to make an omelette. That is kind of the Donald Trump mantra, right?
Oh, well, he loves talking about eggs, doesn't he? He seems to blame... Well, like he blames everything on Joe Biden, he's blaming the surge in the price of eggs on Joe Biden now. So, but what you're making a very interesting point is that we've got, the potential for a bit of a supply chain wobble here. I think people will be looking closely at what stocks that companies have got, particularly things like retailers. Are they already sitting, anticipated this might happen, and are they sort of stocked up? Because I did note some action on the commodities market today as we're recording this on Wednesday. Now, this seems that China is sort of taking preemptive measures and is sort of boosting its stockpiles of strategic metals. That caused copper prices to jump 2%. We saw zinc, aluminium, nickel, all moving higher. I think the danger here is that essentially could pull forward commodity sales for all the big mining companies. Now, they might find later in the year, China says, actually, we've got plenty. China is the big commodity consumer. It might say, we've got enough stuff. We don't need to buy as much from you. So it puts a big question mark about their earnings. The next set of earnings might be pretty good, but the one after that might not be as good. It's all down to what is China doing? Is it a stockpile, or is it a true definition of reserves that won't be touched? They're there and untouched for as long as possible. So, yeah, more confusion for people to get their head thrown.
Certainly is. But one sector that has been doing incredibly well, particularly this week. I mean, Monday, just looking at the FTSE 100, it hit a fresh record high. European markets were up. Now, this, of course, is before the tariff wobble, before Europe started to get very nervous, particularly about the luxury goods sector and car makers. But we did see a lot of big defense companies putting on millions and millions to their market capitalization because investors were hearing the words that were coming out of this summit that was held in London between Keir Starmer, Emmanuel Macron at the weekend, the support for Ukraine, this coalition of the willing, who else might potentially be involved. The one thing that we do know is that it is going to require more spending on military hardware. And we know the UK government has committed to spend 2.5% of GDP. It's already started making some of those investments. And I've heard a number of really good arguments about the fact that although people are really nervous about where that money is coming from, what potentially it might do to Rachel Reeves' budget and her plans for spending on infrastructure projects, but actually when you're spending on defence, that creates jobs. It creates jobs in places that you might not otherwise get jobs. So I know particularly the north of England, the Midlands, there's a huge manufacturing sector there which will benefit from this. But it's been really interesting to watch some of those stock movements over the past few days.
Oh, I mean, it's like Rheinmetall in Germany, and we've got obviously BAE, as you mentioned. There's Chemring, Cohort. There are a lot of stocks that have been moving high. What's interesting is that these stocks have already been moving for a couple of years, really, because they've been off the back of when Russia invaded Ukraine. Investors saw this as essentially a wake-up call for the defence sector had been out of favour for quite a while. Now it had the prospect of government sitting up, taking notice and saying, okay, we really need to think about protecting our own areas and also helping our allies as well. Now we've got this sort of indication spending could be even greater. So, they've had a really strong run. Of course, BAE is the one that, perhaps UK investors will perhaps know the best. But I think most people, they know the company, they're aware of what it does, but I don't think people know the ins and outs exactly of how it makes money. It's quite, it's very big in cybersecurity now as well. So this is why we've asked Tom Sieber, Ian Conway, our experts from Shares Magazine, come on the show and ask them to do a proper deep dive. So let's hear what Tom and Ian have now got to say.
So defence business BAE Systems is a name which will probably be familiar to most of you who are listening. But what might have escaped your attention if you haven't been following it that closely is that since the start of 2022, there's only one other FTSE 100 share that has beaten its 190% odd share price gain. And that's its relatively close counterpart, Rolls-Royce, although Rolls is much more weighted towards civil aerospace and BAE is much more focused on defence. And it's only second to Rolls so far this year too, with a 40% advance.
That's interesting. Well, I mean, what's behind that, Tom? Because when I look at a chart of BAE Systems, it's kind of it went sideways from 2014 all the way through 2020. It didn't have a good pandemic. Stock hit 5-year lows in 2021. What's behind this run?
Yeah, so it's no coincidence that I referenced performance since the start of 2022, because that's when the shares really began to fire on all cylinders. And it probably wouldn't be a surprise to most of you that obviously that coincides with Russia's invasion of Ukraine in February of that year. And understandably, that's kind of shifted the calculus in terms of the expectations of how much global governments, and I suppose in particular European governments, might spend on their militaries. And then subsequent to that, so obviously I referenced how well it's done year to date. We've seen what looks like a fairly significant shift in US foreign policy under the Trump administration, which in turn looks like it's going to require European countries to bolster their defense expenditure even further, and to an even greater degree than had been anticipated. And that's been really getting the stock moving considerably higher in just the last few weeks.
Okay, so can you talk us through what it actually does, what it makes, and where it sells it?
Absolutely. So it operates across 5 different divisions. So you've got electronic systems, and a lot of these names kind of give a pretty clear clue to what they actually do. So that's operating in areas like electronic warfare, navigation systems, sensors, surveillance, communications. It also has a bit of a footprint in the emerging space sector as well, partly bolstered by the acquisition of Ball Aerospace, a US business it bought last year, and that's around 25% of sales. Then you've got platforms and services, possibly less clear exactly what that does based on the name, but that was around 15% of 2024 sales. And that makes and upgrades combat vehicles, weapons. It also operates in the munitions space. And then the largest division by sales last year was actually its air division. So obviously that's things like fighter jet programs and tactical communications. Then you got maritime, which is around 20% of 2024 sales. And the rest is focused on areas like cybersecurity and digital intelligence. And from those businesses, particularly recently, the company's been generating plenty of cash flow, and it's been fairly sort of busily returning that to shareholders too through buybacks and share dividends.
So another thing that kind of piques my interest, Tom, is the company seems to get a lot of sales in the US, and yet when we look at US defense companies, they haven't been performing very well this year.
No,
What's the
that's a really
story?
salient point. Yeah, absolutely. And you know, that's very true. In 2024, the company got 44% of its sales from the US, and that's by a distance, the most significant contributor by geography to its overall sales. So yes, it is quite weighted towards the US. And notably, while we've had this kind of big boost in the prospects for military expenditure in Europe, seems to be a much less buoyant picture the other side of the Atlantic, particularly given there seems to be an agenda among the current occupants of the White House to reduce federal spending. And to illustrate the sort of difference in sentiment, at least, US defense company Lockheed Martin is down some 20% over the past 6 months, which compares with a 20% plus gain for BAE over the same time frame. So despite the fact that it is quite US orientated, it's enjoyed the kind of rally that other European defense names have enjoyed, and it's avoided the sort of sell-off that its kind of US counterparts had experienced. Another kind of key point is that BAE operates on some quite long-term programs. And as my brief summary of the business illustrated, munitions is a pretty small slice of its overall sales. Now, these long-term programs, which include things like the work on the submarine alliance, the AUKUS submarine alliance, so that's the combination between Australia, the UK, and the US, they run for decades, which is obviously a positive thing in terms of investors being able to be confident in future earnings prospects. But it does mean that any benefit from increased European military spending, which you'd think is likely to be focused in the short term on supporting Ukraine's battlefield capability might take some time to come through. So, the order book is at record levels, 77.8 billion. But while, you've seen this big reaction in the BAE share price to what's been going on recently, it may take longer for that to be evident in the kind of, the top and bottom line for the company. And much is also going to depend on how the company executes on the opportunities it's got in front of it. So, BAE has had issues in the past with things like cost overruns and delays, and that could undermine sentiment towards it.
Yes, I mean, the shares have had an amazing run. They're up, almost fourfold from before the Ukraine conflict started. So I wonder, are we getting ahead of ourselves still? Are we confident in the company's prospects for the longer term?
Yes, I mean, I guess you'd have to argue that given, some of the big shifts we've seen recently, there is, you can point to a positive direction of travel for the company. It certainly looks like European countries are going to have to boost their spending on their militaries quite significantly from where we are at the moment. And it's, it's quite possible. We talked about how BAE has this big US weighting at the moment, that geographic split could look quite different in a few years' time. So while it derives, significantly more of its revenue from the US, nearly 50% of its workforce are based in the UK, so that, they are potentially able to pivot over time to where the best opportunities are. I think, as you say, it's apparent that investors have been busily pricing in an improved outlook for the business. So we have seen earnings grow since 2022, but they haven't perhaps inevitably kept pace with what has been a very rampant share price. So we've ended up in a situation where the price to earnings ratio based on forecasts is around 16 times. And that's some way above the 15-year average, which is less than 12 times.
Thanks so much to Tom and Ian. I think it's really useful sometimes to do a deep dive like that on a specific company, particularly in a sector which is garnering a lot of attention. Now, I wanted to talk about a company that always grabs attention, even if they're not doing particularly well at the moment. And I was absolutely fascinated because I'm going to talk about Greggs now. I love a Greggs. I'm a northern lass. I've always loved a Greggs sausage roll. My favourite breakfast is a Greggs bacon butty and a cup of tea. I don't want any sauce, thank you. But we've seen a huge rollout of Greggs stores. It used to be I would go from the north down to the south and I'd be like, where's the Greggs? And you just couldn't find one. Now, you certainly don't have that problem anymore. In fact, you can find Greggs just about everywhere. And it's not just the high street because, it used to be that most of its stores, 4/5 a decade ago, were on the high street. Now the company reckons that almost half of its shops are in alternative locations like, petrol forecourts, transport hubs. I've just come off a train. There was one at the train station. You also got them in places like universities and hospitals, which has certainly raised a few eyebrows when I've been talking about Greggs over the last week or so. And on the face of it, you would think, Greggs' revenue passed £2 billion last year, thanks to higher sales of things like pizzas, chicken goujons, potato wedges, and yes, still sausage rolls. And profits, pre-tax profits, hit 204 million. That was up 8.3% on the year before. So far, so good, you might think. But shares fell quite a lot, 12% on the news from Greggs on Tuesday morning when it released this earnings update. And that is all down to growth. For a while, Greggs just looked like it was on steroids. I mean, it was just growing at an incredible momentum. As I say, because, you had sort of this proliferation in the north on the high street, but other locations, not so much. And it's really been sort of rolling itself out in other locations to a point where the last earnings updates from McDonald's, a big US giant, mentioned the United Kingdom and the fact that another competitor had cornered the breakfast market. And although it didn't specify Greggs, we all know it was talking about Greggs. But there have been a few things which have really started to slow things down, slow things down significantly as well. So we're seeing now that it is having to put prices up. It's put the price of the really popular sausage roll up, which drew quite a bit of ire from some people. But that, it says, is down to the fact that it's going to have to deal with these higher national insurance contributions. It's also having to deal with the increase of the national living wage and all sorts of other additional costs as well, which are causing it a bit of discomfort. Now, it's planning to expand its menu, to increase trading hours even further, grow its digital sales. So there is room for it to continue to grow, but it just feels, Dan, like that period of sort of supercharged growth potentially might be coming to an end. And when people start to get to a point where a value offer becomes expensive in their mind, that I think is when alarm bells really should start to sound for companies like Greggs, because it has been able to push and push and push at an open door. People have been able to go in, get what they wanted to get at a reasonable price. It was always the same, and consistency, massively important. But first of all, people are thinking about price. And secondly, eating habits are beginning to shift. They have been beginning to shift, I think, really since before the pandemic. And people are now looking for something which is a healthier option. Greggs is beginning to deliver that more and more, but its sort of core offer of those pasties, the steak bake, the chicken bake, the pizza slices. You can tell I know the menu. I go quite a bit. But its core offer, not so healthy.
Well, it's got burgers now as well. So to me, it feels like it's going all over the place. I think it's being too aggressive with its growth. Of course, you talk about it needs to cover the extra costs linked to the budget. Of course, it needs to cover extra costs linked to opening more stores as well. But yeah, it's not. It's you go in there, and I always feel like it's not. It definitely doesn't feel like a value retail sort of chain anymore. It feels like it's you have to hand over quite a bit of money if you want to buy. Let's say you got there's 2 or 3 of you got your kids or something. It's definitely not cheap. So I think people, investors looking at it and going, well, this was always all about affordability. You feel like you're getting really good value for money. And people like a sausage roll. Now it's quite pricey, and it's all about burgers and goujons, potato wedges, hot food sort of thing you get in a kebab shop. It's like, I don't know. I've been sensing a slight shift in sentiment towards the stock, and the fact it fell 10% in the market shows you investors are getting a little bit, I don't know, grumpy with it, maybe, or just really disappointed.
Maybe they're just disappointed at the cost of a sausage roll now. Look, we've seen some changes as well, Dan, to the way that London markets look in terms of listings. And you're just going to talk us through what's going on.
Yeah, I mean, so last summer, we had some changes to the rules. If you wanted to float on the stock market, essentially just trying to make it easier, particularly for sort of entrepreneurial type people, to come on and get these shares admitted to public trading. At the same time, we had some tweaks about whether how you can sort of qualify for inclusion in the main sort of stock indices. So if you're not quite sure how this all works, you'll hear about things like the FTSE 100, FTSE 250. These are sort of, essentially, think of them like they're baskets of certain stocks. Lots of people would love to be in these baskets because it's sort of representative of the prestige. So if you're in the FTSE 100, you're in the 100 biggest companies on the UK stock market, and it's like the blue chip badge of honor here. So quite a lot of companies might have been big enough in size but there's certain little characteristics about the type of listing or something else that stop them getting in. So we've just had FTSE Russell, which is owned by London Stock Exchange, say that for later this year, from September, if these companies trading on the UK stock market have their shares priced in dollars and euros, they may now be considered for potential inclusion in these FTSE index series. That's quite interesting at the moment, because obviously it's just restricted to pounds presently, but opening it up, it's just another sort of step forward in trying to make the stock market a bit more attractive. And there's also going to be some tweaks to new companies that join, well, not new companies, but new IPOs, first time a company admits its shares for public trading. Normally you have to you come on and you have to wait a few months and wait for the next quarterly reshuffle of the index before you can be considered. Now it looks like you can get, within your fifth day of trading, if you're big enough, you can get onto these indexes. So that will cause a bit more moving in and out of the shuffle, rather than just happening once a quarter like it is currently. So I think it's it is a quite complicated topic, but I think if you are really into investing in stocks and shares, people follow these things very closely and they like to know the ins and outs about how it works. Just as we're recording this, we'll find out tonight which companies will go into the next quarterly reshuffle. And it looks like Coca-Cola Euro-Pacific is going to be, for the first time, be included in the FTSE 100. This is a part of these changes to these listing rules. There is another company that joined the market recently called Canal Plus, which is the French company that owns various sort of media things, and it's also does film and TV production. It's behind all the Paddington films. That's big enough to go into the FTSE 100, but it doesn't abide by UK takeover rules, so it's currently ineligible for inclusion. But I think that later in the year we're expecting to see a big uptick in IPOs. We'll perhaps do something on the podcast in a bit more detail. I'll try and explain it in a more simple way as well, rather, because I appreciate this week we're talking lots about tariffs, we're talking about individual companies, defense sector and stuff, so it's a lot to sort of take in. But hold fire, we will come on to this in more detail when time is on our side.
It does seem at the moment that time just keeps getting away from us, because there is so much to talk about at the moment.
Definitely. Okay, let's talk pensions now. And who better to chat to than AJ Bell's Head of Public Policy, Rachel Vahey. Now, Rachel, I've seen quite a lot of articles and reports around talking about plugging gaps in your national insurance record. Can you tell me more? And what exactly is this about?
Hi, Dan. Well, this is all about making sure that you can get full entitlement to your state pension. Your state pension is a really important part and foundation to the retirement income that you're going to get in later life. It's currently worth about £11,500 a year. So you can get a state pension if you've paid in at least 10 years of national insurance contributions. And you can get the full state pension if you've paid in 35 years of national insurance contributions. But there are some people out there who, when they get to state pension age, just haven't paid in that number of years contributions. They haven't made the full 35. Now, they could have done that because they've got some gaps in their career, or because they've lived abroad, or even because they've been contracted out. So it's worth checking out whether this applies to you, especially if you've got any concerns about this. So the first thing I would say is to check your national insurance record. And you can do this quite easily. If you just Google that, you'll be able to get a link up from the government and you can go in and check. If you do have some gaps in your national insurance record, then what you can do is to pay some voluntary national insurance contributions, and you can plug that gap. And you can do this really quite easily. Now, usually you can only plug up to 6 years, a gap that's been there up to 6 years ago. But there is a special offer on at the moment from the government, a special window of opportunity. That means up to the 5th of April this year, you can go in and plug a national insurance gap which has arisen since 2006. So this is a really special opportunity to be able to get your state pension in order and your national insurance contributions all paid up.
Can we put some figures on this? Is it worth doing? Ultimately, how much would you potentially get extra? Could you get?
Well, it can be a really financially savvy decision, this one. If you pay £900 of national insurance contributions, you could get an extra £330 a year to your state pension. Now, you've got to remember that is going to be paid for the rest of your life. So an extra £330 for the rest of your life. And what's more, at the moment, it's guaranteed to go up by the triple lock guarantee. So that is going to be the highest of the increase in earnings or inflation, or 2.5%. So a really good increase on a fairly good amount. So it could really be worth doing. But before you rush out and get your debit card out or your checkbook out, just a couple of words of warning. It's not going to be suitable for everybody. So just do a few checks. Even if you've got a gap in your national insurance contributions and your national insurance record, it could be that you just make that up naturally as you carry on working. So if you take someone who is in, say, their mid-50s, they may think, I've got a couple of years gap. I really should do something about that. But if they're going to carry on working for the next few years, then they're probably going to make up that gap anyway. And so they don't need to actually pay in any extra money. It could also be that you are entitled to some free credits from the government. For example, if you took a couple of years out because you were looking after somebody and you were caring for someone, if they were, say, under the age of 12 or an elderly person. So you might be able to get some free credits and make up the gaps there. Also, when you come to contracting out, I mentioned before that if you're contracted out, you could have gaps in your national insurance record. But this is a really complicated area, and it's difficult to say with any certainty whether if you can pay in national insurance contributions to plug that gap. It really depends upon each person's personal circumstances.
So I guess where can someone go to get more information? Is there actually someone that they can talk to about this?
Yes, well, they can get in touch with the pension service and the government's pension service. And again, you can do that quite easily if you just have a Google and see if you can get in touch with them. Now, the government realises this is it's created, as you said, a lot of media reports and a lot of interest. So the government realises this is, there is a demand for their pension service to try and figure out if it's worth doing. So they've anticipated this demand, and they've said that if you get in touch with them and then you request a call back, and as long as you do this before the 5th of April, even if you get that call back after the 6th of April, so when you're into the next tax year, when you get that call back, it leads to you plugging in national insurance contributions, then that will be honoured, even though you're making the payment in the next tax year rather than this tax year. It doesn't matter. They say, well, we will still honour that agreement, because they do realise this is really popular, and they're obviously getting a lot of phone calls from to the pension service. And I think that's a really pragmatic approach the government's taking. But if you want to go ahead and pay in some money about your national insurance contributions and to plug those gaps, then you can do that really quite easily online, or you can even do it via post.
Brilliant. Well, Rachel, thank you ever so much. It's very interesting stuff. And of course, if anyone does want more information, like Rachel said, a lot of stuff has been written about this online already. So hopefully you'll be able to get exactly what you need with a sort of minimal amount of searching. Brilliant. Rachel, thank you ever so much for coming on the podcast. Let's turn our attention to mortgages, because there's been a lot in the headlines this week about the return of the sub 4% mortgage. That sounds absolutely fantastic if you're trying to get on the housing ladder and you want to have cheaper cost of borrowing. So Danni, what's been going on here?
Yeah, so on the face of it, this is really good news. As you say, the headlines are great. There are a number of lenders now offering fixed rate below 4%, TSB, Barclays, Nationwide, HSBC among them. But, and I have to stress this, there are a few caveats because although it is making it easier and more affordable to buy a home, you do need to have a large deposit, at least 40% to get the deals below 4%. And many of those cheaper deals actually come with a number of catches. So it means that not all borrowers are going to be able to get them. Some require you to already have a mortgage with the lender. Some require you to have a green home in order to be able to access a particular deal. But I think it does show the direction of travel at the moment. And more lenders are beginning to put these rates on the market, reducing fixed rates in their range. And it is headline grabbing, but it does require you to sort of stop and take a look and maybe talk to a broker to find out what deal is right for you. Now, we are expecting that rates should fall further over the coming months. But I think what we do see is that the pace of those reductions is set to slow. And certainly there's just such a huge amount of uncertainty around when it comes to things like inflation. We started talking about tariffs. It kind of is a neat circle to be able to end up talking about tariffs as well, because they could be inflationary. And clearly, although we're in a position at the moment where we've had the Bank of England cutting interest rates, it is watching very carefully to see what happens. But a lot of brokers suggest that by the end of the year, the best sort of 60% loan to value 2-year fixes could be around the 3.5%. Now, clearly, that depends on things continuing to progress the way they are, and it doesn't account for any market wobbles. And we do know, of course, that we have a little thing called the spring statement heading our way, and there have been lots of commentary about the potential for some big moves in the spring statement. Although it's not going to be a budget with a lowercase b or a capital B, it is still, I think, going to be significant and headline grabbing.
Are we allowed to call it a mini budget, or is that sort of disciplinary action if I say things like that? We don't know, I think, is the answer, don't we?
I think spring statement is safe. We'll go with that.
Yeah. I mean, there is obviously there's been lots of speculation around what if Rachel Reeves announces changes to how much money you can put into a cash ISA. And I think that mortgage lenders have looked at this and going, that could be problematic, because I think people might not realise that banks and building societies essentially take the money that people are saving on deposit, and that helps to fund the money they lend out for mortgages. So if there's a reduction in the amount of money that people are saving with banks and building societies, it could lead to more expensive mortgages. So not wanting to be full of doom and gloom, but
let's end on a bright note, Dan. Yeah. Why don't we, just for a change?
I mean, I guess if you're obviously own a home now, and you're thinking, okay, perhaps this is the year where I need to think about my fixed term is coming up, or I was thinking about remortgaging. As always, there's lots of sort of moving parts, and it's kind of hard to prepare to think, should I do something now, or can I wait a bit longer? And it's like, I have a lot of sympathy for anyone in this situation.
That is me. My 5-year fix comes to an end in December, and I keep looking and going, yeah, maybe 6 months out, I actually need to start locking something in just in case. So, I'm watching very closely.
Yeah. Well, that's all we got time for this week. If you've got any questions for the team, such as any pension specific questions for Rachel, or you'd like us to look at a bit more detail about a particular area, or certain types of investments, we'd love to hear from you. drop us an email. The address is podcast@ajbell.co.uk, or you can find us on social media. Next week, we have an ISA special, so make sure you don't miss that one. And also listen to our sister podcast, the AJ Bell Money Matters, because they've just done a really interesting report into the gender ISA gap. So until next time, thank you very much for listening.
Before you go, please remember this podcast is for educational purposes, and the views expressed don't necessarily reflect those of AJ Bell or Shares Magazine. The podcast isn't telling you if a certain investment is suitable or not. Don't forget that the value of investments can change, and you can lose money as well as make it. It's also important to remember that how you're taxed will depend on your individual circumstances, and rules can change. The way an investment performed in the past may not be the same as how it behaves in the future. If you want help, go see a qualified financial advisor.